Welcome everyone to today's ISTAT Learning Lab. My name is Jen Zhu. I'm based in Singapore with Alton Aviation Consultancy. In today's Learning Lab, we welcome our returning guests, John and Evan, to continue their discussion on asset-backed securities, the ABS market. John and Evan has started the ABS sessions since 2021 on this ISTAT Learning Lab platform, and today is the fourth year they are presenting a market update on this topic. For the previous ABS sessions, you can access the recordings on the ISTAT website. So before we start our discussion today, I would like to provide a short bio of John and Evan for our audience who might not have participated in our previous ABS discussions. Mr. John Murray is a co-founder and managing director at Alton Aviation Consultancy. John is a trusted advisor to lessors, equity and debt investors on a wide array of aviation asset classes. Accredited as a certified appraiser by ISTAT, John has advised investors on the selection, acquisition, and financing of billions of dollars in aircraft and aircraft operating leases, and he frequently works on large and confidential transactions. Mr. Evan Wallach is currently President and CEO of Global Air Finance Services, with a primary focus on advising institutional investors on investing in bonds and other securities issued by aircraft and engine leasing companies. Evan also advises aircraft leasing companies on the purchase, sale, and financing of aircraft and aircraft engines. So the format of today's session is that John and Evan will join in present their views for about 60 minutes, and then we'll open up for an audience Q&A session at the end. So we would like to encourage the audience to use the Q&A button at the bottom of the screen to send in any questions you might have as we go along the session. So now let's welcome John and Evan to start their presentation. Thank you.
Okay.
Sorry, John, you're on mute.
Thank you, Jen, very much for your kind and fine introduction to Evan and I. Are we okay on screen visuals?
Yes, we're all good.
That looks good.
Excellent. Well, on behalf of Evan and I, we're really delighted to have the opportunity to participate in another ISTAT Learning Lab. As Jen shared, this is our fourth in as many years, and it's really an honor to be back and to share with you our perspectives. Today's title of the presentation is Aviation ABS Market Environment Update, and our objective is to share an update with the whole ISTAT community. And we do have a couple of recent updates that are very, very recent and very relevant to share with you, given dynamics in the market. So we'll jump in. Just in terms of the agenda and what we'd like to share with you today. The aviation ABS market sits within the dynamics of the broader aviation industry, and it also sits within the dynamics of the aviation financing market. And so I'm going to start off by sharing with the participants today some slides that share a perspective on these two markets. We'll then review some characteristics of the pre-COVID issuances, and Evan is going to provide an update on the performance of pre-COVID ABS. We'll then repeat the exercise and look at some characteristics of post-COVID issuances and look at their performance as well. We'll certainly be pleased to take stock of any questions that have arisen at certain points throughout the presentation, but principally at the end of the discussion, and we'll address those to the best that we can. So let's begin then, if we can, with our first topic, a review of the overall macro environment for the aviation industry. What we can see here in the chart at left is some figures that show passenger air traffic demand trends since the start of the pandemic. And it wasn't too many years ago when COVID induced a 90% drop in passenger air traffic demand. But what you can see from the dark black line showing the global recovery, the recovery has been significant and nearly on a straight line, and it's also now been fulsome. If you look at what happened around the end of the year 2022, the industry had only recovered to around 77% of the pre-COVID levels. If you look at the end of 2023, the industry had recovered to almost fully. It was at 98% of the pre-COVID traffic levels in December. But here in the summer of 2024, air traffic demand has surpassed the 2019 levels by around 10%. And we anticipate that air traffic demand growth will continue going as we go forward on the back of sustained economic activity growth. The most significant pickup probably over the course of the last 12 or 18 months has been in the Asia Pacific region. At the end of 2022, it was still only at 57% of the pre-COVID levels. And as a large market constituting historically around a third of the overall demand, this was very significant in weighing down the overall average. But now here, summer 2024, it's again ahead of pre-COVID levels. So fulsome recovery there. As we move past this important inflection point or point of full recovery, we do anticipate that growth will continue to be sustained. But we do have to take into account that there's seasonally adjusted, of course, with typically the Northern Hemisphere winter season being a bit slower than the summer season. Looking at the chart on the right-hand side of this slide presents the percentage of aircraft that are parked, and we segment this according to the age of the aircraft. What you can see is that clearly when the pandemic was at its peak, airlines set down aircraft of all age vintages. Around 50% of the fleet went on the ground, almost irrespective of the fleet type. As the pandemic carried on and carriers decided that there was demand to reactivate those aircraft, we can see a very significant difference between their reactivation of the very youngest aircraft to the very oldest aircraft. And of course, it was the youngest aircraft that came back into service first. I think if we look at the segment of where we are today and focus on that green line at the bottom, these are the aircraft of less than 5 years of age. And as a whole, compared to the parked fleet percentage for those young, less than 5-year-old aircraft today is actually less than we were at the start of the pandemic. So a fulsome recovery on a percentage basis. I think it's interesting, you can see a bit of a blip here so far in increasing in 2024 for this very young fleet of aircraft. And we attribute this to the manufacturing challenges associated with the powdered metal of certain GTF engines on the A320neo family aircraft, most principally. I think important to note the pre-pandemic reference back in January 2020 had other similar issues with aircraft. And in fact, the 737 MAX fleet was grounded at that time because of the safety issues there. But in aggregate, it's aircraft less than 5 years old are parked at a lower rate. If you look at the next bucket of aircraft, those between 5 and 15 years of age, this is the light blue line in the center. And this is really where the most significant recovery has come over the course of the past few years. Of course, as air traffic demand has come back and we've been in this supply constrained environment with manufacturers challenged to increase production and the durability, reliability issues of some of the new technology aircraft, these aircraft are really the workhorse of the fleet. They're the 737 NGs and the A320ceos, high degree of reliability and providing a lot of capacity for the system. Interesting to note that because of the GTF issues, it's actually this segment of aircraft, those quote midlife 5 to 15-year-old aircraft, those are actually have a parked fleet less than the aircraft less than 5 years old on a percentage basis. Interestingly, in the change from last year, what we see is that those aircraft older than 15 years of age, we've also seen a fulsome recovery there, and the parked fleet of those older aircraft is indeed less than we were pre-pandemic. So it speaks to the strength of the recovery to have this level of reactivation of parked fleet. Flipping to the next slide, this translates into, of course, this higher demand and for higher growth of air traffic demand and aircraft coming out of service. It translates into some indications of an aircraft shortage, and that's translating in through to higher values and lease rates according to appraisers. So it won't surprise, of course, that during the pandemic, because of the demand reduction, aircraft values and lease rates fell. What we're showing here are published appraisal lease rates from other third-party appraisers for current gen narrow body and wide body aircraft. Collectively, the types on this screen, we've chosen to profile these particular types because collectively these types constitute around 2/3 of the aircraft that are in the aircraft ABS issuances since 2015. So representative of many aircraft that are in the ABS issuances. The top shows the A320 and the 737 NG, and we've got the wide bodies at the bottom. We show them the trends for constant age 5, 10, and 15-year-old aircraft. If we look at the top left in particular, we can look at trends on the A320-200. And we see that appraised lease rates declined from before the pandemic. They were north of $300,000 a month. They dipped down below $200,000 a month at the depths of the pandemic, so a very significant 33% reduction. But they've continued to recover in the post-COVID years, and the rates today aren't too far from where they were before the pandemic. We see a very similar trend for the 737-800. That recovery in lease rates obviously important because, as we're going to talk about, financing costs have increased for lessors as well. So that increased revenue, of course, required to service generally increased costs of financing. I think what we see is whereas those young current generation narrow-body aircraft declined by around 1/3 in terms of lease rates, younger generation wide-body lease rates declined by closer to 50%, as you can see here from the figures on the A330 and the 777. The published sources that we've used to create this slide haven't reported a recovery in lease rates on the wide body, but our own market intelligence suggests that for wide bodies, perhaps the decline in lease rates could have been even more than shown here, but that the recovery is firmly underway and has been more fulsome than shown here as well, according to the published data. Leasing, of course, is not just an asset play, it's very much a credit play. And so it's really important to understand the state of airline financial health. And the chart on the left highlights trends that we monitor with respect to reported financial ratings for more than 100 airlines. And to be clear, these are not credit ratings per se, but financial ratings. We can see that COVID caused a migration away from what was pre-pandemic healthy set of BBB and BB ratings for many airlines in the universe and they declined into the CCC and CC world. But you can see there's been a continued improvement in 23 and 2024. But if you compare where we are in 2024 to 2023, in general, the financial position of the airlines in aggregate isn't what it was on a pre-pandemic basis. Many have taken on substantial debt loads. So I would say that airline credits, therefore, continue to be a mix. There are actually many very strongly capitalized airlines that are flush with cash and equivalents and paying for aircraft on an outright basis. And on the other hand, there are a number of airlines that didn't restructure, but perhaps needed to during the midst of the pandemic and seem to be teetering a bit on the edge of viability or on the edge of a restructuring at a minimum. If we zoom out and look at the aggregate financial performance, noting that there can be a significant variance on individual airlines, in the chart at right, we see the overall trends on airline industry revenues, costs, and profitability over the course of the last decade and anticipated for 2024. We can see that the very strong dip, of course, in revenue and in profitability during the depths of the pandemic. But we can also see that in 2023, revenue recovered fully and exceeded pre-pandemic levels. And the industry profits were not too different from where they were in what I'll call the good old days before the pandemic. In 2024, revenue expected to grow again significantly for the airlines, but importantly costs too. And that's going to keep profitability relatively in check, with overall profits expected this year to be quite similar to what they were last year in 2023. So that shares a perspective on the aviation markets, and I'll flip to what we see in the aviation financing markets and some trends, and I'll seek to put kind of ABS into context into those markets as well. From a macroeconomic perspective, we're always concerned and watching and looking to see what's happening with some of the core inputs for airlines and lessors. Those include fuel prices, currency movements, and inflation. And while we had concerns about all of these dynamics 12, 18 months ago, they were all shooting red flag signals. Much of our concern in those areas has dissipated. But interest rates would, of course, be the other major macroeconomic indicator that has caused us some concern, and that really sustains. I think important to note that over the last several months, we've seen a pretty substantial reduction in interest rates from what was a near-term peak. So as by way of example, 7-year treasuries have dropped around 100 basis points since April. So a very significant reduction that you can see on the slide here. But still today, those 7-year treasuries are around 2 times higher than they were pre-pandemic, and something like 7 times higher than they were at the depths of the pandemic. So depending on your basis of comparison, they're still a bit elevated, but not as elevated as they were. Base interest rates are, of course, not the only determinant of yields, and we'll come to discuss some of the spreads and changes that we're seeing there. But in general, on a theoretical basis, one would anticipate that higher interest rates experienced by lessors should result in higher lease rates, and that would be, of course, required to maintain margins and profitability for the lessors. But we haven't seen an instantaneous response in the form of lease rates elevating to compensate for the higher interest rates. In sale-leaseback transactions, we think it's been more prevalent, and lessors have sought to price on a certain date, and then the lease rates will float until the time of delivery, and that provides protection to the lessors. And in some cases where that protection has been in place, lease rates have moved up, very significantly. But that has been a very competitive market, and many of the lessors funding those sale-leasebacks have had access to debt capital that wasn't priced at sort of the spot market lease rates, and that's probably kept some of the lease rates in check. In the lease placement market, we don't think that interest rates are a significant immediate near-term determinant of strength in lease rates, and for us, we look at sort of placement lease rates as being more a function of the supply and demand balance. And of course, as we talked about, it's a tighter supply and demand balance. So we have seen significant pickup from the depths of lease rates. But that's important, of course, because of the higher interest rates. I think, I've made this point, before, but I think it's important to take into account the long-term perspective of what interest rates have done and are doing. And, over the past couple of decades, the sort of glory days of aircraft leasing, there has been this great experience of declining interest rates, which has always helped lessors who have and owners of assets that have looked to trade out of assets. We're now in certainly a period of more elevated interest rates. The last time we were in this sort of interest rate environment, you have to go back to sort of the 2008, 2009 time period. Approach these levels more recently, but on an absolute basis, that's how far back one needs to go. So, we do have a little bit of concern about the ability for lessors to trade assets if they aren't hedged, if they had signed up leases in a low interest rate environment at thin rents, and then to trade those out into a higher interest rate environment can become challenging without sufficient hedging in place. So flip the slide then, taking into account sort of that big shift in interest rates. This next slide characterizes the overall commercial aviation financing market. I think important to note and to clarify that the slide excludes the business and general aviation market and excludes the helicopter market. These are meaningful but substantially smaller parts of the aviation ecosystem. But if we look just at that commercial aviation financing market, we see over the course of the past decade around $1.6 trillion in value. Pretty steady before the pandemic at around $150 billion, peaked almost doubled in 2020, as the COVID pandemic set in, and there was this very strong requirement for additional capital and liquidity from the airlines to sustain their businesses. And there was support from the governments in the form of quantitative easing and other to provide this support to aviation and more broadly to the economy. In 2021, we saw another significant period of issuance. This was a period when the lessors actually took on very significant amounts of capital. They were relatively quiet in 2020, but in 2021, when interest rates were through the floor, lessors really took advantage of that to one, to help support some M&A and some very large M&A transactions that took place. And also it was an opportunistic time to come to the market with ABS issuances and term out some of the warehouse loans that they had used to build up portfolios. But look what happened when interest rates rose in 2022 and in 2023, much more muted levels of activity. Through August year to date, muted activity again as well. It looks like 2024 overall volumes of aviation financing probably not too dissimilar to what we saw in 2023 if the first three quarters, the trends over the first three quarters extend through the fourth quarter. Zooming one layer lower into debt capital market activity, because ABS activity is a subset of debt capital markets, we're seeing similar trends here as we do overall. I think for debt capital markets, the major drivers of volume in this market tends to be airline and lessor unsecured bonds, and historically this was the biggest driver. We see airline EETCs, lessor ABS, other secured bonds from airlines and lessors as being important, but historically substantial, smaller parts of the overall market. But again, the similar trends and what sticks out is that lower volume of activity 2022 so far through to 2024. Again, higher interest rates made the opportunities or the options here less attractive. There was less need. Airlines and lessors levered up very significantly in 2020 and 2021. So having done so, their requirements for additional financing has been more muted. And as well, they found alternative solutions in the form of commercial banks, alternative lenders as well, which has allowed borrowers to not lock up for the long term at higher interest rates. Flipping then to trends in aviation ABS volume, you can see here the light blue bars are showing the overall volume of commercial aviation ABS issuance. Historically, it's accounted for around 7% of total aviation debt capital markets. But what we compare here on this slide, I think is quite interesting, is the volume of ABS issuance relative to the amount of used trading between the lessors. There's a difference between causality and correlation, but we can see in the period of 2018 up through 2021, the volume of, there was very much a relationship between the volume of ABS activity and the volume of trading for lessors. I think a fundamental part of sort of the big lessor business model has always been to acquire new or very young aircraft at certain prices, hold them on the balance sheet for a number of years, and then trade out of them to midlife market participants, if you will. And the typical trade from those large lessors has been, historically, it was through to financial investors via e-notes and commonly with the ABS securitizations, but also trade sales. But a lot of those trade sales, if they weren't to a large balance sheet lessor and they were to fund lessors, they went into a warehouse or acquired via a warehouse financing and then termed out via ABS. So the ABS market historically has been a very important contributor to overall liquidity in the market for lessors. You can see in 2023 and 2022, there was less trading activity and there was less commercial ABS issuance volume. We saw just one engine deal in 2023. So there was, of course, trading. So clearly other financing channels have been used to facilitate the trading. But perhaps with a reopening of ABS markets, we would see more liquidity and more trading activity. In 2024, we've seen overall ABS issuance volume now exceed what we had in 23 and 2022. This was driven by, and earlier this year, Carlyle's Asset 2024-1 issuance. And then just last week's BBAM came to market with a Horizon 2024-1 issuance. The numbers have been updated this morning because there are two new issuances now in the market. One from DAE and its Navigator 2024-1 issuance, and then Sky Leasing with its SLAM 2024-1. So whilst these have not yet closed, they're in the market as of now, and we've included these figures in the statistics here, which will bring the total issuance to date through September up to $2.4 billion for aviation ABS. We'll talk about these more later. I do want to put into context the aviation ABS market relative to the broader ABS market as well. And what we see here is a breakout of total issuance in the ABS market, aviation and otherwise. And if you look at the stacked bar chart, it's a little hard to see aviation. The reality is aviation has historically constituted only around 1% of total issuance. Other asset classes to keep in mind, residential mortgage-backed securities, student loans, auto loans, et cetera, are all substantially larger ABS markets. And there's been a pretty strong continuation of ABS issuance into secured by those asset classes. Here in 2024 year to date, there's been around $230 billion of issuance. So the ABS market broadly is open. It's just that in the aviation space, there hasn't been heretofore really a great match of the bid-ask spread. Lessor investors have effectively demanded an interest rate that to lessors and issuers didn't make sense. But we're now seeing a bit of a convergence, I think, with the two new issuances and the pre-sales out yesterday. So I think the overall, what we'll see is that the overall volume for this year in 2024 as a proportion of the overall ABS volume is going to be similar to what it's been historically, around the 1% level. Jen, I don't know if we have any questions yet at this point that we can take into before we advance into the next section on reviewing some pre-COVID and post-COVID issues.
We don't have any question yet. So for the audience, if you have any question, feel free to send in through the Q&A button at the bottom of the screen. So John and Evan will be able to address them maybe after the discussion from Evan.
Okay.
Great, thanks, Jen. Then let me just carry on and just to characterize a few characteristics of some of the pre-COVID issues, and then I'm going to turn it to Evan, who's going to take the audience through the performance of these. So I think just to frame pre-COVID issuances, I think these really took a left punch and then a right punch from the restructurings that came about in the fallout of COVID, followed by the impact of the Russian invasion of Ukraine. And in this chart, what we've characterized is the exposure that ABS issuances in certain years have had to airlines that are known to have restructured either in court or out of court. And what we see is that generally the exposure to this was around 15 to 20% of these pre-COVID portfolio issuances. It's interesting to note that even certain 2023 and 24 deals have exposure to the GOL Chapter 11 and to the SAS Chapter 11s. But these typically were well known by investors and rating agencies at the time of issuance, and so would have been treated appropriately in the underwriting. But on top of the COVID and the restructuring exposures, a number of issuances prior to 2021 and even some early 2021 issuances were exposed to the Russian invasion of Ukraine and the subsequent sanctions. And we assess this to be on average around 4 to 5% of the portfolio exposures had aircraft that were seized or otherwise exposed. But of course, individual deals will vary, and in some cases, as much as close to 20% of the portfolio had been exposed to the situation there. So what's the situation now? Well, cases are being held in litigation in various global courts, and the situation is quite dynamic. You can see that some lessors, AerCap and SMBC, have settled on certain portions of their portfolios or exposures, and the sums have been significant. In the case of AerCap, at least $1.2 billion of settlements. In the case of SMBC, at least $700 million so far, and that doesn't speak to the totality of the claims in the aircraft. Reports came in today that from a Russian news source that 133 Aeroflot's negotiating now over 133 aircraft on insurance settlements as well. With respect to ABS, of course, collections of these amounts have the ability to significantly enhance cash flows that are coming into the structure, into the waterfalls. But of course, the amounts and the timing are extremely difficult, if not impossible to project. On the restructuring side, I think important to note, again, around the pre-COVID issuances, what was the impact? Of course, as we showed earlier in the slides, lease rates declined quite significantly on a market basis, but that impacted around 15 to 20% on average of the portfolios because of the restructurings. On this slide, we're just giving an indicative example of what a restructuring would have looked like for a single aircraft. And at the top, we can see a rental profile that might have been anticipated prior to COVID for a 9-year-old aircraft, narrow body that would have been on a 12-year lease. So it had a few years of term remaining at the time of COVID. What you can see, we would have expected, maybe it was leasing at around $350 a month, and the expectation would have been, after a brief period of downtime, it would go back on the lease at, north of $200,000 a month for a 5-year term, and then go out on another lease. The middle chart shows what might have happened and how airlines that needed liquidity relief but didn't need to restructure or had a viable business plan for the future. Lessors and airlines worked together, and lessors effectively were agreeable to reductions in rents and deferrals in rents, often in exchange for deferrals. And so you can see, lower initial rent, stepped up rents into the future and extended terms of that initial lease. And in some instances, we're seeing that those step ups in rent coming through and flowing through aircraft leases and making their ways, of course, into the top of the waterfalls. Some situations were not as fortunate, however, and economics would not have been preserved. In these instances, the lessors had to take back the aircraft, incur transition costs, and then typically we're putting out the aircraft in the worst case scenario on no minimum initial power by the hour types of structures. But then as the market, as time went on, minimums, and then up to a fixed rate. In certain instances now today, the dynamics are very different on an individual sort of aircraft by aircraft basis. If the lessor did a short-term lease at sort of those distressed rents, they're now in or have recently been able to renegotiate extensions at significantly stepped up rates. On the other hand, if the lessors signed up and put these aircraft on very long-term rents very long-term leases at low rents, there's probably a bit of regret in that not able to take advantage right now of the stronger market today. I'll turn it over to Evan, who's going to sort of take you through how some of the characteristics around what we're seeing on the lease rents have played into some of those pre-COVID issuances. Evan?
Yeah. Thanks, John. No, the good segue from the previous chart showing, what happened during COVID with respect to rents either staying the same, being deferred or restructured. So if you look at the chart on the left, this is a representative of 4 of the pre-COVID deals that we looked at last year. Wanted to bring it up to date on how improved collections have been, beneficial to the pre-COVID deals. And as you can see, as leases turned over during 2023-24 in the pre-COVID deals, servicers were able to renegotiate those leases higher. So I think overall what we've seen is an improvement in collections on the pre-COVID deals. But the bad news is that they're still significantly below where we were in when the bonds were issued, reflected in the 2019 levels. So good news is collections are improving and continue. Bad news is they're still significantly below. And I guess the question is, is there a window where they will go higher, or is this the level that they're going to peak at? And these are the rents that we're going to be receiving for the pre-COVID deals. For bondholders, this translates into the metric called debt service coverage ratio, or DSCR. When new issues came out, the typical target is this number had to be at least 1.2 times coverage for each month, and it's calculated each month, based on principal and interest payments coming in. Again, you can see that in spite of improved collections, the DSCR numbers continue to deteriorate significantly, and we're even below below 0.5 on most of the deals. So this, we'll go to the next. When we see the next chart, you can see what this translates to with respect to the waterfalls. So next slide. So again, this is what bondholders are looking at each month, and as you can see, the calculation that they're looking at is, though collections have improved, rents have gone up a bit, even deferrals have been recovered. There's been an improvement in actual aircraft sales proceeds as well. Most of that is going to the Class A's only. And so you can see that the differential between the actual bond levels and what was expected based on issuance, it seems to have stabilized, but it's still below where bondholders were expecting their bonds would have amortized to as of 2024 for the Class A's. So what this means is that as collections continue to come in, Class A's most likely, after replenishing maybe the maintenance account, the Class A principal will be receiving those additional payments. What this means for the Class B's is that they will only continue to receive interest only, in our opinion, in our modeling, for the foreseeable future. As you can see, that's all they've been getting since COVID. And as a result, the actual balance is way behind where, or much higher than where it was supposed to be, based on the actual at the time of issuance. And for the Class C's, frankly, the story is a lot worse, because the Class C's have not been receiving either principal or interest, and basically as a result, the C balance is getting higher and higher, because it's picking what was supposed to have been received that's being added on to the actual balance for the C's. So what this is saying is that the performance for the pre-COVID deals is getting, in general, it has improved from where it was last year with respect to the Class A's. But until the Class A's catch up, if it's before the expected ARD date, the B's won't be receiving anything. Now, we have seen a couple of deals where actually for the pre-COVID deals, the B's are starting to receive some principal, which is a huge benefit if you're buying the bond based on basically an interest-only calculation. So anyway, that's it's a trend that we're starting to see a little bit more of in the secondary market. But unfortunately, it looks like for most of the pre-COVID deals, the performance is still subpar from what was expected at issuance. Next. And so this is reflected also in the rating agencies' actions. When bonds were issued, the A's and the B's were investment grade and received appropriate spreads for that classification. However, because of the shortfall in collections and shortfall in paying down bond principals, The Class A's are still, for the most part, investment grade, though, certainly, in the triple B average category, most, if not all, of the Class B's have now crossed over from the triple B issuance into double B category, which has a big impact on on the investors who bought the bonds, thinking they were getting a little bit higher coupon, a little bit better spread, and now they're being hit with capital charges because of the downgrading on the Class B's. And unfortunately, the C's, have initially came out for the most part, double B. Most of them are now either single B or have fallen into the Class C category as well. So quite a big impact for initial investors that bought bonds based on the ratings. Okay, next. So there was, as you know, very little new issuance activity since we last spoke in September of 23. But there was a great deal of pickup in activity in the secondary market. And that's kind of the world that I live in. So we work with investors in modeling out many of the pre-COVID deals. We do about 25 of them each month to basically come out with what do we think the projected cash flows look like, for the pre-COVID deals, and what price does that translate into and what yield does that translate into for the Class A's and B's and C's. So we definitely saw a lot of activity in the secondary market on the Class A's. Bond prices moved from low 80s, high 70s into high 80s, low 90s. Still significantly below par from issuance, but at the same time, I think investors are getting much more comfortable with, at least for the Class A's, some certainty of expected cash flows for the remaining aircraft lease portfolios, and also an improvement in collections, a stability of collections, both from rent and as we'll see later, an increase in sale activity for pre-COVID aircraft as well. Next. Last year when we spoke, there was almost no activity in the Class B's in the secondary market. I think that we are now seeing, investors are now taking a close look at the B's. And again, now that as we're coming out of COVID with a little bit more certainty of cash flow projection from the existing portfolios, we actually are now seeing investors taking a hard look at some of the opportunity in the Class B's, and again, significantly below par in terms of bond prices. But we've seen them move up from a $50 price to a $60-$70 price, and what investors are doing is they're being sophisticated. They're using good models for projected PVs, future cash flows. And basically, they're assessing what's the right yield for the risk of those cash flows. And so for the A's, I think investors in the secondary market on pre-COVID deals are saying, 8 to 12%, is probably the kind of expected yield I should be getting for that risk. For the B's, they're saying, well, it's even more uncertain. As we showed earlier, it looks like they're just interest only for a long period, and there's a guess as to when the principal will start being repaid. But again, bondholders, sophisticated bondholders are doing the work and basically saying, okay, if I'm in that level of uncertainty, what return should I get for that kind of risk? And yes, there are opportunities where you can get a 15%, 18% IRR at the right price for the B's. So again, the dealer desks are doing a good job creating secondary activity and trading in the Class B's. So, again, I think, we saw no new issuance activity, but I mean, frankly, we had a couple of clients that were, targeting the Class A's, and, we're able to achieve, high teens, low 20s IRRs for being involved in the secondary market of the pre-COVID deals. Looks like that's kind of stabilized now with rates coming down. So we'll see if that activity continues going forward. Next. Okay.
Thanks, Evan. Yeah, let me jump in just to set the framework for some of the post-COVID issuance. I think Evan's just reviewed the pre-COVID performance trends, but here what we've shown is all of the issuances of commercial leasing, aviation leasing, so distinguished from, there have been some issuances in aviation lending ABS issuance from Stonepeak, PK, Ashland Place, which aren't profiled here. But in terms of leasing deals that have closed since, there were 14 of them in 2021. So those are shown at the top here. More limited volumes, 2 issuances in 2022, just 1 engine issuance in 2023. As of yesterday, this chart had just 2 issuances for 2024, but both now 2 new issuances are in the market, and so we've appended those to the end of the list here. So we've got 4 in the market or closed so far in 2024. I think what's interesting to note, if you look at those 2021 deals, most of those I'd say would be considered core aircraft, kind of middle of the market, typical of A320ceos and neos and 737-800s. These transactions, because of the very low interest rates, achieved very low pricing, and as low as Series A notes is as low as 2.4, 2.5%. So pretty remarkable given where we are today. But I'd also draw attention to the fact that in the 2021 environment, there was a huge amount of diversity as well. In the regional space, we saw Falco come to market with its inaugural issuance, single tranche of debt, low LTV, higher coupon, but the deal still got done. 2 engine deals were closed, one from Willis, one from a portfolio that had been sold but still managed by GCAS. Castle Lake refinanced one of its older ABS issuances in 2021. It was pretty remarkable. It had an average age of 18 years. So the market proved its flexibility there. But clearly when interest rates rose up in 2022, the market had been different. I think when 2022 started, we had a high degree of optimism, given there was a strong finish in 2021, but the Russian invasion really caused a pause in issuance volume because of the uncertainty. Inflation caused the rise in interest rates, and ultimately limited the volume for most of the rest of 2022. Again, 2023, we just had the single engine deal from Willis Lease. It's their 7th in a series of successful securitizations that they use to take aircraft out of other bank financings and put them into longer term financing. Here in 2024, at the bottom of the list, I think you can see Carlyle got off with the inaugural issuance for the year with its asset 2024-1. Initially issued an A1 note for a certain number of aircraft, came back, issued the A2 note, which brought in a subsequent number of aircraft into the financing, and then came back with a B note issuance. And I think overall, from the coupon for the A notes around 6.3%, an LTV for that A note of around 69%. Just last week, BBAM brought to market a successful transaction for Horizon 4. It was only it's a single tranche deal. I think they've reserved the option to come back to market with a second tranche. But it yields just expected yield is around 5.4%, which is nearly 90 basis points below the Carlyle issuance that took place a couple of months earlier. Because of some significant part was attributable to the base rate compression, but also some compression in the spreads. So quite a significant movement over the course of a couple months there. And then, as alluded just yesterday, pre-sale reports had been published by certain rating agencies for DAE's Navigator fund. So this is the new 2024-1 issuance, and also Sky's SLAM 2024-1 issuance. I think 22 aircraft in each of those portfolios, a touch older than the Carlyle and the BBAM issuances, but still with pretty healthy lease term remaining. one has a dual tranche, and the second Sky has just a single tranche at this point of 8 notes. If we compare some of the trends on these at the time of issuance, I think some interesting dynamics you can see here. The very low interest rates and reflected in the A coupons for the sort of pre-COVID deals, but also the 2021 issuances. The step up for aircraft up to 6% in 2022, albeit a limited volume, and so far, averaging below 6% in 2024 on the basis of the Carlyle and the BBAM deals that have closed. Don't yet know where the DAE and the Sky deal will price, but those are in the market as we speak, to our understanding. I think what is a little bit different in the pre-COVID times and in 2021, there was a very strong level of volume for junior tranches. We see this in the chart at the top right. 2022 featured single straight A tranches. And in 2024, we've seen a mix. Half of the issuances have had a second tranche, half have not. But overall, on the junior tranche level, a bit lower leverage. Interesting trends with respect to the portfolio makeups at the bottom left. Pre-COVID and in 2021, a lot of diversity, a lot of older gen technology, even in 2022. So this would be NGs, COs, A330s, 777s. But the 2024 issuances have been quite different. That light green block in the middle is representative of next generation narrow body aircraft from the A320 Neo family, the 737 MAX family, and the A220 family as well. You're seeing that lighter gray bar at the top would be next generation wide bodies from 787s, A330 Neos, and potentially A350s as well. So quite a different makeup in the underlying portfolio. And in the chart at the right, what you see here is a comparison of the underlying leases and the assets, the age of the assets and the remaining term of the leases at the time of issuance. So up through 2022, on average, the age at issuance was sort of 8 or 9 years of age. And on average, the leases had approximately 4 years of term remaining. We've seen an inversion so far in 2024, with a young fleet age averaging less than 5 years of age and more than 7 years on average of lease term remaining, which coincidentally should extend out beyond 2 or beyond the typical 7-year anticipated refinancing date. So interesting trends, very live, hot off the press, with a couple of two new issuances reflected there. But I'll turn it to Evan, who's going to talk through some of the performance of both pre-COVID and post-COVID.
Yeah. Yes. Thanks, John. So I think taking that last chart that John just went through, you can see how it's really like a tale of two cities, where the pre-COVID deals are showing here in the waterfall performance, most of only getting down to the Class A principal level. You have a few that get down to the B principal, but for the most part, you're really looking at pre-COVID deals that are only paying down to the Class A principal, which means that the B and the C are just getting further and further behind as to where they're supposed to be. And it does mean that the anticipated refinancing date, 7 year from issuance, is blowing through. We've seen a couple of 2015, 16, 17 deals hit their ARD and are just continuing, to pay down from where they are, because collections are behind expected. So I think from a bondholder standpoint, those that were buying what they thought was a 5-year average with a 7-year final for the A and the B, and a 7-year final for the C. Unfortunately, they're not getting the economics that they thought they were going to get, and there's a lot of uncertainty as to how far the expected final payment will be for those pre-COVID deals. But the other side, given the characteristics of the post-COVID deals, newer aircraft, longer leases, maybe better credits, the performance has been much better, and has actually, for the most part, been on schedule. And so bondholders at this point for 2021 deals, to some, for most degree, but certainly the 22 and where the recent deals, these payment waterfalls are on schedule, and so it looks like there's been an adjustment from the characteristics of the structures and the portfolios, which are keeping the post-COVID deals on track. Next. We also wanted to highlight the engine deals compared to the aircraft deals. The demand for spare engines has been off the charts, for the last couple of years, and this is clearly being reflected in the performance of the engine ABS deals, which has been fantastic. And mostly, I guess Willis has been the primary beneficiary of using the ABS market for the engine deals. Engine deals are primarily driven by short-term leases, so there's a lot of turnover. So, as the demand has skyrocketed for green time engines, the lease rates have just gone up significantly, and so the collections have gotten significantly better as well from management of the engine ABS portfolios. So we think that that should continue going forward. Okay, next. All right, so I think just to do a quick recap of what we've been through, again, looking at the positive negatives of the pre-COVID and the post-COVID deals. So for the pre-COVID deals, the good news from our, a year ago, yes, lease collections are definitely higher and more stable. Many leases have actually been extended, either at the expiration date or even before. Again, looking at 25 of these deals every month, we were looking at aircraft being 17, 18 years old, maybe coming out, being parted out. Well, we're seeing leases now going out into aircraft ages hitting 22, 23 years. Again, a reflection of the problems with the new aircraft deliveries and how that's filtering down to this incredible strong demand for lessees to just keep their aircraft because of the uncertainty of any new deliveries coming in. Also, we've seen from last year, most of the AOGs are now either back out on lease or they've been sold. And we've even seen, frankly, some of the big lessees, to name, an Air France, a KLM, they've actually been buying their older 20-year-old aircraft when they're coming off lease, because again, they need the lift and they're exercising that option. So that's all good for the pre-COVID deals. Yep, the settlement on insurance proceeds don't separate out, Air ABS portfolios. So, whether it's AirCap or Air Lease or SMBC settling, with the Russians on seized aircraft, some of those aircraft are aircraft that are in the ABS portfolios, and so bondholders are getting the benefit of that. And from the secondary trading standpoint, again, we were seeing a nice pickup in pricing for in the secondary market for the Class A's and even for the Class B's to reflect higher demand and better collections, better performance for the pre-COVID deals. The negatives, unfortunately, are the collections are still below where they were expected to be. The balances, as we shown earlier, are below where they were expected to be. The B's are interest only, the C's are picking. And unfortunately, yes, there's been quite a pickup in aircraft sales, but the actual proceeds have been below the note target balances for those MSNs, because as the balances have gone up, you've had to allocate more debt to individual aircraft. So unfortunately, the proceeds just haven't been meeting, where the no target balance is. So unfortunately, that's creating again a bigger shortfall. And again, the LTVs currently are significantly higher than what was forecast at the time of issuance, and as a result, refinancings have just not been able to happen on many of the pre-COVID deals. Looking at the post-COVID deals, again, most of the assets have had few disruptions. Bonds are performing as expected because of that. And really, not much negative news for the post-COVID deals. Bond prices have come off due to interest rates, not because of performance. So when bonds were issued, A's and 3.5%, 4%, and the 5-year Treasury was at 7%. Clearly, the adjustment in the market was to lower the bond, the dollar price for the bond. But now that's with with Treasuries coming down back into the 3.5% range, we should start seeing secondary bond prices for the pre-COVID deals moving back up into the closer to par from where they were. Moving along quickly. So just taking a quick look at the constituents, the impact in each of the primary constituents. From the current bondholder standpoint, those that bought bonds for the post-COVID deals, I think are fine. However, the bondholders who bought pre-COVID issues, the biggest impact is uncertainty of repayment, and in many cases, B's and C's might not get paid in full. So they've had to accept the economics and maybe had to take some write-downs as a result. The E-note holders have been impacted the most on the pre-COVID deals. Many of them are never going to see another dollar. Some will. I mean, I think that there's a couple of deals where, again, if looking out into the future, some of the E-notes will recover. There was an auction on an E-note a couple of weeks ago, where it did trade, in the 10-cent range, but it did trade. So that's actually a little bit of positive sign. It looks like E-notes for post-COVID deals are going to be okay, but also for the most part, I think the servicers and the issuers now are taking that position, currently for that equity. So they're going to hold that until maybe in the future they'll be able to trade out of it. The commercial banks, I think, are finally seeing some light at the end of the tunnel on their warehouse facilities. I think that's a big part of what's driving the issuance that we're seeing in the last couple of weeks. As we're seeing 3.5% Treasury on the 5-year. So that's good for the warehouse bank. I think they'll be there again, but probably a lot more selectively than where they were previously. For the aircraft lessors, the driver for using the ABS product, to get gain on sale, from an accounting standpoint, may be limited going forward. But the lessors now have many alternatives, given the depth and breadth of the capital markets for aircraft lessor financing. ABS is now just one small alternative that they can use when the numbers work. So I think that's a positive. I think the large asset managers and the equity funds, I think they'll be very selective coming in when the portfolios look right with certain managers. So it looks like it'll continue, but maybe a little bit more selective going forward.
Thanks, Evan. I think I'll close out with the following slide just to take a step back from ABS and just bring everyone holistically to where we are. I think of course the worst of COVID-19 is behind us, and hope the Russian invasion moves beyond us for not just this aviation and investment community, but those personally impacted by the tragedy there. Of course, risks do continue to show. There are certain airline credits that need to be carefully watched. Geopolitical risks do seem perhaps more present than ever. But unlike in the last couple of years when air traffic demand was not as robust, traffic is now fully recovered. There is the cap on production driven by manufacturers' inability to raise production to the rates that they would like, and coupled with the lower reliability in the aircraft that have come out of service because of certain manufacturing issues and otherwise. So the aircraft supply demand balance now is tighter than it has been in the last 5 years. So that's great. As a result, lease rates have advanced toward, or in some cases above, where they were pre-COVID. This is vital because of the costs of financing for the industry have increased quite significantly with those interest rates. Of course, as lease rates move up, then we would anticipate that the values for the aircraft would move up as well. So long as conditioned on sort of how long contracted lease rents are in place. So still perceive that if you have an aircraft that was put on a low lease rate during COVID with a very long term, it may be hard to sell that because the financing costs are elevated at the moment. But we do see this thaw in the ABS markets as being, and the contraction in interest rates for the coupons is being very healthy for the aviation investment and leasing community. It may foreshadow an increase in further ABS issuance coming to the market, but also increased trading of aircraft as well for the lessors. We think this trading is very important for the lessors. They need to be able to recycle their capital to finance upcoming new deliveries as the manufacturers do raise production rates. Alton's forecast calls for around $100 billion of deliveries by 2026 and around $140 billion of deliveries by the end of the decade. It'll need support from the lessor community. The lessor community in turn will of course require support from both commercial bank partners and the capital markets. So I think with that, Jen, that really concludes the scheduled presentation, and we'll turn it back to you if we can.
Yeah. Thanks, John and Evan, for this very insightful presentation. And for the audience, if you have any questions, feel free to send through the Q&A button while we have John and Evan live on the session to address your questions. So I guess I will start with a couple questions related to the collection during COVID. So the first question is why the collections are still below their 2019 levels for pre-COVID deals, given a booming aviation leasing market now? Is it mostly due to Russia issues or airlines struggling financials still recovering from COVID?
Yeah, I think it's exactly as answered. In the question. So of any aircraft that was leased into Russia, I think we showed it is on average 4 to 5% of the portfolios were exposed to Russia, but in some cases, as much as 20% of the portfolios were exposed to Russia. So of course, there are no proceeds coming in, or no collections from any of those aircraft. So that's borrowing one-time insurance collections, but on a monthly basis, typically not seeing any there. And then on the other aircraft, anything that restructured during COVID, I think we tried to take the audience through those 3 slides. There were, for some aircraft, there were deferrals and things were pushed out. In other instances, wholesale restructurings, and oftentimes, moving to new lessees, and they had to be placed at very low rates. So it's a combination of those 2 factors that are driving the lower collections. But Evan, you may wish to add.
And I also think that there's a lag effect also, where, if you restructured a lease or had deferrals, back in 2021, 22, it's, you have to live with that, with those lower levels until maybe now or next year, when maybe they'll start to pick up again. Also, the aircraft have aged, so, what was a lease rate for a 10-year-old aircraft, 5 years ago, you now have a 15-year-old aircraft, so that the overall the overall number for that aircraft is going to be lower than maybe what you thought it was going to be when you issued the bonds. So that's really kind of my observation. The observation is, it looks like, I don't know if we're going to get better than where we are right now with respect to collections on the pre-COVID deals. So we may be stuck with these, with these lease rates at 67, 70% of what was expected going forward.
Mm-hmm. And do the lost cash collections from the COVID period get written off?
Not necessarily written off. It's a pretty simple structure. These ABS trusts are just, they're not companies. So basically, there's no write-off. There's no accounting, that has to be done as if it was a company. Basically, it's cash comes in, cash goes out, and that's the net is what you end up with. The other, just one other point also with respect to paying down bonds, I think because of COVID, you also had a lack of payments into the maintenance accounts. So, maintenance events that were maybe put off for a year or 2 or 3, now they're coming up. And so now bondholders have to, the waterfall, you have to put money into the maintenance account to cover maintenance events that may be coming up in the next 12 months that weren't accounted for in the previous 12 months. So those numbers are definitely not going to bondholders. They're going back into the aircraft.
Mm-hmm. Yep. Thanks, Evan. And a similar sort of related question is, since now, especially this year, most North American and many European airlines are talking about a overcapacity in the market and a softening in the demand. So would this soften the demand of aircraft and resulting in a lease rate pressure, which ultimately, again, will impact the return on the ABS?
Yeah, I mean, I can offer some thoughts there. I mean, for sure, there are some segments of the market which have, have more capacity than is, required at the moment or desired. There are a couple of airlines that are overexposed to capacity and perhaps looking to reduce capacity. I think, I would look at sort of the overall, medium term. I would look at sort of, our expectation is that air traffic demand, will continue to grow as economies grow. There's a very strong correlation between overall GDP activity and air traffic demand, and that gives us a view as to what will happen in the medium term. There certainly can be, bumps along the way, but I think, look, in terms of, so is there potential for a bit of softening? I think there probably there's certainly some potential risk there, but I think on the other side, we have seen regions like Asia Pacific come back quite strongly, where there is, very, very significant and robust, traffic demand. We're not seeing any indicators as of now that sort of, values or lease rates are softening. We're still seeing, quite significant strength on whole assets as well as on, engine, demand. So, yeah, I think, our outlook continues to be, favorable for the near term, notwithstanding that there can be certain situations which are challenging. Evan.
Yeah. No, I mean, just one metric, looking at, the reports every month, what we're seeing is extensions of 2 to 3 years right now. Airplanes coming off lease now, they're going out another 2 or 3 years versus, we saw some leases that in 2020, 2021 that went out to 2030, 2031 to kind of lock in because of the uncertainty. So I think lessees are like just covering for the next 24, 36 months, and then basically saying let's see what happens and what's available going out a couple of years, but not going out 10 years.
Yeah, I think to Evan's point, the 20-year-old aircraft, plus are probably more marginal types of aircraft where you're seeing good extension activity now that we wouldn't have seen in the last couple of years. So what happens with traffic demand and what happens with new supply of aircraft from the manufacturers will dictate how many of those continue to extend versus make their way to conversion or part out in the next couple of years.
There are a couple more questions related to pre-COVID deals, but given the time being, I think we can only take one or two more questions. So I will move on to there are a couple questions related to the structure of how ABS has changed. So I think one of the questions is asking what are the most meaningful changes to the structure for recent deals?
Yeah, I think that from a fundamental standpoint, it's the composition of the portfolios that's been the most significant change. So pre-COVID, most of the airplanes were, say, 10 to 12, 13 years old going in, expected to stay in for 10 years. I think what we're seeing in the post-COVID deal structures, the most significant change is younger aircraft and longer leases and maybe better credits. And so the overall, result of that is just more certainty of cash flows. I think that's really what investors are saying. There's too much risk with smaller lessees, older airplanes, short leases, turnover. Give me something that looks a little bit more certain. There's a little bit more certainty to the cash flows, at least over the next, say, 5 to 7 years from issuance. And I think that's giving investors a little bit more comfort. And it's also I think the issuers and the bankers are responding to that, which is a good thing.
Mm-hmm. And do you think would there be sort of a shift in the structure or the content of the ABS, given the impact of the recent geopolitical events on portfolio performance and secondary market liquidity?
Yeah, I mean, with respect to geopolitics, for sure. I mean, there have always been, in instances there have been, exposure concentration limits with respect to, certain jurisdictions, and certain jurisdictions have been, off limits. I think since the invasion of Ukraine, I think certainly one or two more countries are appearing on that list of exclusions for reasons of sanctions and otherwise. So yeah, I think that's the type of shift that we're seeing. I don't think it's significantly broader than that at this point in time.
Mm-hmm. Yeah, thanks. Given the time, I would just take one last question. I think this question is also quite interesting. So there's an audience asking, why is there any market receptivity of ABS, especially in a new structure which provide interest for B tranche before the principal for A amortization?
Mm-hmm.
And also, I think recently we saw a lessor recently issued a WETC. So I guess it's just overall just market sort of interest in ABS product in general.
Yeah, I mean, so I spoke to one of the bankers about that. I think you're referring to the Carlyle deal, that basically they issued the A tranche, and then when the B was issued, the waterfall didn't change. So it's interest to the A, principal to the A, and then interest to the B, and that's a complete difference from the traditional structure where A and B receive interest first. So the opinion of this particular banker was that that was something that they needed to do to accommodate the issuance of the B tranche at that time, but he did not think that was going to be a structural change which was going to be done to all the waterfalls going forward. So no, it was an interesting twist. I mean, the question I had is, was the B properly compensated for that additional, risk, being clearly subordinated to to the Class A. I think in the case of the Carlisle deal, they were, but will that continue? I don't, it's going to be a function of what the demand is for getting the B and the C, if possible, a C, issued in the future. I'm sure, the bankers will adjust to whatever the demand is from the investors.
John, any response to that? No?
No, I think Evan's captured that well. Thanks.
Okay, yeah. So there's still quite a lot of questions that we are not able to address today. And I believe John and Evans share their contact information, so feel free to reach out to them after this session separately if you have any questions you would like to get their answers. So thank you very much, John and Evan, for this very insightful discussion today. And thanks to all the audience for joining us today. The recording of today's the session and the presentation slides will be published on ISTAT website in the next 24 hours. Sure. And we look forward to seeing you in our future ISTAT Learning Lab sessions. Thank you.
Okay, thanks very much.
Thank you.